Well, let's connect with Chirag Sethalwad, and it's one of those shy fund managers who rarely comes on TV. So we had to come all the way to HDFC AMC to bring him out. See, आप नहीं आता हमें आना पड़ा. That's the only way to get you out of your shell.
Thank you so much.
When we spoke last, you were of the view that long term is intact, but the near term was getting slightly wobbly.
Sure.
That was based on your assumption of the earning valuation matrix. We've seen a sizable correction after that. Has your view changed?
I think things are more reasonable now. So you've seen in the indices themselves have corrected 7-8%, and surprisingly mid-cap, small cap, large cap have all corrected to a similar extent. But within that correction, individual stocks have obviously corrected much more. So if you look at CNX 500 as an example, I think more than 100 stocks have corrected by 30%. So I think there has been some rationality which has come. And as a result of this correction, what used to be a 40-45% premium has come down to a 25-30% premium. This is in mid cap and small cap. In large cap, that premium was not very large to start with and is now down to about 10%. So large cap valuations were reasonable and continue to be reasonable. Small cap and mid cap were expensive and now are less expensive certainly, but are not still close to averages. But I think considering the outlook for the Indian economy and for a lot of these companies, I think some premium is justified, but I still do believe there is a little bit of froth still left in the market. I think it's maybe possibly a little bit more in mid than it is in small, because a lot of the small caps have corrected quite substantially, and now individual opportunities are certainly emerging.
Nobody saw this kind of an earnings slowdown coming in. How do you read into the kind of quarterly numbers what we've got?
I don't think that is true. I think the slowdown has been very visible for the last 3 quarters. We've seen earnings growth. This quarter was, in single digits. Last quarter was in single digits. The quarter before that was in single digits, and it's been steadily coming down. So I think that has something that I think we ignored. So this is typical of a bull market, that you sort of ignore the bad news and focus on the good news. And but that slowdown was visible. Margins were running at, I think, 10-quarter highs, so 2.5-year highs. And I think we were ignoring the base effect as well. So I think the earnings surprise has now gathered attention because market corrected, and when the market corrects, you look for a reason for that correction, and now we've pointed at the slowdown. But I think in general, the slowdown was visible. We knew even a few months ago that government spending was suboptimal. We knew of the urban slowdown. So I don't think this is a surprise. I think this is just a recognition of what was happening on the ground.
So what is the right way to look at the earnings cycle? Is it like a mid-air turbulence and the earning big picture which started post-COVID that is still intact? So this is like a spot within a long-term cycle?
I think overall earnings will be okay. I think the challenge is going to be from a raw material standpoint and from a profitability standpoint. So the problem of the problem is that revenue growth is reasonable, but margins are quite high. So if margins were to come down, then earnings can come under pressure. So far what has happened is we've seen margins expand. So revenue growth has been okay, but margins have expanded, and hence bottom line growth has been quite strong. This is going to be difficult to sustain from a margin standpoint going forward. So if margins stay where they are, then you will just mimic pretty much revenue growth, which is not bad. But if you want to sustain sort of higher numbers, then you need to see margins sort of sustaining or actually increasing, which may not happen because raw material prices are not benign.
Post-COVID, we've seen a lot of interplays, which is that it started with this whole concept of cheap liquidity and revenge shopping. Then came the inflation scare. After that, we saw a mad gush of liquidity by the retail guys, and which really took everything higher. So the script of how 2025 and beyond would move, what would dominate that?
From a liquidity standpoint?
No, generally, for the markets.
I think it's going to be, markets are not going to be one way. I think there is going to be a lot more volatility. You have to be a lot more stock specific. There is no particular sector, barring financial services, which stands out as being cheap. So I think you have to drill down to individual companies. I think you have to be a little bit more nimble-footed, in the sense that when markets come down and individual stocks correct, then you have to take that as an opportunity. Sometimes it's market-driven, sometimes it's stock-specific. But there will be, I think, a lot more volatility. This is not going to be an easy run like the last couple of years. There is a lot of ammunition for volatility, both from an economic standpoint as well as from a political standpoint, not necessarily in India, but also outside of India. I think global markets may also be a little bit more turbulent. Most markets are at close to all-time highs, which is whether it's Australia or US or Japan and so on. So I think there is going to, I think we are in interesting times, and I think this is probably going to be a market which will separate the men from the boys. Not everybody is going to make as easy money as they have in the past.
So if one has to really gauge the market, the last 3 years versus next 3 years, one is expect more volatility, B, keep return expectations diluted. But in terms of outperformance and underperformance, where do you see the entire needle moving?
I think outperformance will tend to increase. Alpha pool will expand, and that is not a surprise. In a market which is sort of one way, the sort of high beta players tend to do well, and everybody else lags. In a market which is more volatile, the market becomes a little bit more discerning. It becomes easier to generate alpha. It's very hard to beat a market which is rising as fast as it has in the last couple of years. It's much easier when the market takes a breather, right? Because things become a little bit more rational. You start looking at fundamentals a little bit more. So that tends to play to a lot of people's strengths, such as ours. So I think this is an environment where overall returns may come down a little bit. Alpha will probably expand a little bit. But still, overall returns will possibly be a little bit lower in the next sort of couple of years compared to the last couple of years. You cannot have this kind of fantastic return environment continuing, forever.
But you expect positive returns, which is what I just want to take back as a message. It is not that you think that we are at that juncture where the returns would be compromised and we should brace ourselves for a big fall or a crack. At least that is not the risk.
Over a couple of year period, I don't see that a reason to believe that we will have negative returns on a compounded basis at all. But in a 3, 6, 1 month, 3, 6 month or 1 year period, of course you can have negative returns. We have now, it's a shocker to have negative returns. It's from a market expectation standpoint, which is not reality, right? We've had plenty of meaningful drawdowns in the past, so why can't we have a meaningful drawdown going forward? But that could happen in a given year. But over a sort of 3-4 year time frame in an economy which is growing at 12-13% in nominal terms, where earnings growth will possibly be similar to that, yes, you will see valuations coming down a little bit, but earnings growth is still there. So there's no reason to believe that you won't get away with reasonable returns. But it's going to be a little bit lower than the past, and it will be certainly higher than being sort of zero returns, definitely.
The India of yesterday versus India of today versus India of tomorrow would be very different in terms of the earnings pool, Sensex composition, where large part of earnings would come in, who would be the next set of wealth creators. How do you see India of tomorrow changing from India of today?
I think that's a very far-fetched, very forward-looking, and you have to have that vision. And I think, to be honest, things change slowly. So, we know that tech will be a big player and renewables will be a big thing and so on. So I think those things have already been identified. But who will win and who will lose within that is sort of difficult to gauge. But, I'm still a big believer that the more things change, the more they remain the same. So, forecasting what is going to happen 10, 15, 20 years later is very, very hard. We can just about figure out what's happening next quarter, forget about next year and 5 years and 10 years later. But I think, the key is to invest in managements which are executors. I think that has been my big learning. Valuations, of course, are important. Business dynamics are obviously important. But there are some managements who are just fantastic at execution. And when you ride on those managements, even if you get in at expensive valuations, it's a very rewarding experience over a period of time. So I think the key is to look out for people who are sort of obviously hardworking, but also have the ability to execute and manage their environments well.
So I'll pick up the consumer basket, and multiple trends are there. You've got the big FMCG players which are struggling. You've got big hotel companies which are growing. You've got quick commerce which has surprised everybody, and you've got value retail, which was always India ka message. Sasta Sundar Tikau is slowing down. What is happening in this consumption space?
I think each of those have very different dynamics, right? Because in the hotel space, it's very demand-supply led. The supply is weak, the demand has been strong, so obviously that segment is doing extremely well. But it's a cyclical business, so that too will change. Right now we are at a high, but will that sustain? Unlikely. Will it come crashing down or come down slowly? Only time will tell. But let us not forget that it's a cyclical business. When you look at staples, I think right now it is written off, right? Because rural is weak and urban is slowing down. But that's not always going to be the case. In fact, in rural, there are some signs of a recovery. You're seeing demand for Entrega has come down. You're seeing the difference between food and non-food inflation is now favorable from a farmer standpoint. You've had a reasonable monsoon. You had reasonable sowing. So who's to say that 6 months, 9 months later, rural demand will not come back? I think it's difficult to figure it out. So, the minute we write off sectors or subsectors as, this doesn't have much hope, for me, that's always an exciting point to look at a sector, and vice versa. When you look at a sector and say, oh wow, this is fantastic, then for me that's a red flag, because nothing good lasts forever, nothing bad lasts forever. But I think staples, there is a possibility of recovery driven by rural demand. I think in things like hospitality, the demand supply may moderate a little bit. And even in quick commerce, it's fantastic. It's incredibly convenient. We all use it, but there has to be profitability, right? You can't burn through $100 million a month. I mean, at some point, people will stop writing checks, and then what happens? So you have to move to a profitable business model quite quickly. So I think each of these are, we call it FMCG and we call it consumption, but within it, there are so many individual dynamics at play. So you have to look at each sub-segment, and then of course within each sub-segment, you got to look at individual companies to figure out what is going on.
Is that PSU long trade over?
I think it's a huge misnomer, and I think it's a lot of injustice when you categorize PSUs in one sort of basket. I mean, there are all types of PSUs. There are PSU banks, there are PSU defense, there is PSU utilities, there's PSU logistics. Are all these companies the same? Certainly not. Even within sectors, are all PSU banks the same? There are some which are incredibly well run, there are some which are averagely run, and there are those that are badly run. We don't say what's the outlook for the private sector, right? We get down to individual sectors, individual companies, and so on. And I think we have to move away from this, right? And look at specific companies. I think there are those PSUs which are more long-term, which can be more long-term holdings, because they tend to have better managements and better business profiles, and I think those that are cyclical. And I think you have to differentiate between the two. So focus on those which are long-term wealth creators, and then those which are cyclical, you buy them during tough times, either for the business or for the industry.
And you've seen so many market cycles, and you're a big votary of what is called as change. So let's look at a grid which I learned from Ashwath Damodaran a couple of months ago, which is that every business, every company goes through an evolution curve. Starts with startup, then moves into youth, then moves into mature, and then moves into decay.
Yeah.
Put that matrix into play for our viewers, that which are the businesses, companies we can't talk, but which are the businesses which are young, agile, which are in high growth, which are mature, and which are fading away.
I think the answer to that is known in general, but let me just point out, see, we are an economy which is still in a high growth phase, and arguably an economy which should pick up growth. So coming into the declining phase is tough in this kind of environment, right? We are an overall high growth economy. So you will find a lot of companies populating the early growth phase, a lot of them in the reasonable mature growth phase. The decline phase is still a little bit away. Our demographics are strong, our economy is growing well, and so on. But you look at the big sectors, right? I mean, you look at financials to start with. That's a reasonable, it's a mature growth industry. You can grow anywhere from 11 to 15% depending on the environment. Of course, asset quality can come and go. Pharma is growing at 8-10%. Not much volume growth, a lot of it is pricing led, but pharma is still a decent growth business. Capital goods is, of course, a fantastic growth business today, but it is highly cyclical. So I think each of these, I think the great part about India and investing in India is you're investing in a growth economy. So most companies are demonstrating growth. 5-7% growth in India is very disappointing. 10-15% is par for the course, and 20-30% is still high but not ridiculous. And then of course 60, 70, and 80 is all very high growth and will eventually taper down. But I think that's the interesting thing, that most companies on that growth curve with a decline at one end of it, we are at the growth phase. There are few businesses, if at all, which are in secular decline. I can't think of too many.
Where does IT fit in, mature or decline?
See, IT is a global business. It's not an India business, right? So we spoke about these businesses from an India context, right? India pharma, India banking, India capital goods, and so on. IT is obviously a global business. 60-70% of it comes from the US, 20-30% from Europe, and so on. So this is globally a more, obviously a more mature business. India's market share is quite reasonable. So I think the larger companies will have more mature growth. But the mid caps and small caps, their growth can be delinked from industry growth. Your market share is tiny. You can still grow far, far above what the industry grows at. You have to identify trends earlier. You have to hire the right people, and you have to have strong execution. But there are plenty of mid caps, small caps. So NASSCOM comes up with a growth number, and large caps will always be plus minus 1-2%. But for mid caps, they can easily be, or for small caps, they can easily be plus 5, 6, 7, 8%, or minus 5, 6, 7, 8%. So they determine their own fortune more than the industry. But I think in general, of course, IT is a more mature business. It's bound to be. at this size and scale.
At a AMC level, you've got big bets in pharma. If I look at the aggregate pharma exposure
Yeah.
of other AMCs versus HDFC AMC, it's a sizable bet, more like an outsized bet. Now, pharma is very stock specific.
Yes.
But here we are looking at a concentrated bet in a sector. Just a coincidence?
It's very bottom up, right? So that's always been our style. You know us well. We create portfolios on a bottom up basis. So this is a result of us liking individual stocks. And like you said, the business models are dramatically different. There are those who are India focused. There are those who are generic focused. There are those who are somewhere in between. There are those who are concentrated, research oriented, and so on and so forth. So you have to get very, very stock specific. But I think the good news is that the environment is somewhat fertile in the sense that domestic pharma is growing 7-8% without volume growth. So if volume growth comes back, then that's a little bit on top. Hospitals are growing reasonably well, occupancies are high, and US generic price declines are easing. So what used to be 7-8-10% is now coming to 2-3-4%. So overall the environment is reasonably positive, and that creates the opportunity for more ideas. But you have to drill down to a company specific level, and when we do that, we find a lot of well-run companies. And hence we are overweight on pharma, but it's stock specific.
You got a defense fund, you launched a manufacturing fund. So can I say these are multi-year themes which as a house you are endorsing, otherwise you would have not launched these sectoral funds?
Sure, of course. I think manufacturing is obviously much more broad based, and India is playing into this now well spoken of, but China +1 and Europe +1 and so on. And I think that those are trends which will play out for many, many, many years. So manufacturing certainly is a very, very long-term theme. Defense is also a long-term theme because India's defense spending will pick up, and we also have some opportunities from exports and so on. But the problem there became that those stocks ran far ahead of what we thought was reality very, very quickly. So that very long-term theme then became a little bit compromised because of valuations. So we decided to first close SIPs and first close lump sums and then close SIPs.
So SIP is also closed now?
Yeah. So now the fund is entirely shut. At the right time, we will reopen.
Even the manufacturing fund is shut?
Manufacturing fund is open.
Okay. As we look into the future, there are a lot of moving parts. And one moving part really could be the US global policy and the foreign policy, given that there is a change of mandate there. And some of these factors are at play. The China +1 policy which we spoke about, that has only started post-COVID. The India manufacturing theme which we are talking about, Atmanirbhar Bharat, has only started post-2020. In the light of what is happening in Western world, how do you see the global trade balance and how do you see the manufacturing and the supply chains moving?
So globalization is, I'm not a global economist certainly, but I think it's well known that globalization is broken. Right, and we are going back to a very different environment where everybody is trying to be a little bit more self-sufficient, where it is much more bilateral, and gone are the days of this trend towards globalization. And I think fortunately, India is a big beneficiary of that because there is a lot of anti-China sentiment. China is the manufacturing hub of the world, and India is a good place, is a good economy to sort of replace that. And Indian companies are specifically well placed. And of course, there's a large domestic demand pool as well to play into. So I think India will certainly benefit. But when these disruptions happen, it does lead to higher inflation, right? And it does lead to more noise and more volatility. So it'll be more interesting times. But I think India, more interesting, more volatile. But India will certainly emerge, it seems, as a beneficiary of this.
So last but one question: a view of the world. Is it dim? Is it bright? Is it cautious? Is it optimistic?
Because I'm just about able to figure out what's happening at a company and at an industry level, forget about an India economy level. So forecasting global economy is going to be tough, right? But I will repeat what global economists are saying. So we know the US has done incredibly well. So the US is the fulcrum, right? Because it is 65% of global market capitalization and a dominating part of GDP. That economy has beaten everybody's expectation, and you don't want to bet against the US. I think that's something which has proven itself over many, many years. But there is clearly stress there as well, right? Whether it is from a housing standpoint or an inflation standpoint, and you cannot keep beating forever. But I think so. There will be some slowdown there. I think there is certainly a slowdown which is happening in China, which is another large economy, and I think there are some fundamental issues on that side from a consumption standpoint, real estate standpoint. Europe is facing a lot of issues from a cost standpoint. So I think we are in a little bit more challenging environment. I can't say this for the next 5-10 years. I don't have that wisdom. I don't have that foresight. But I think for the next couple of years, it's going to be interesting. It's going to be challenging. It's going to be volatile. And I think that's good. I don't think that's a bad thing. We look at volatility as a bad word. I look at volatility as a very good word. It gives us the opportunity to get into and scale into companies at better prices.
So, like you always say, differentiate between risk and volatility. Volatility is a long-term investor's great friend.
Risk
Buffett
is,
always says.
I was always told by my first boss, risk is knowing what you are doing. If you don't understand what you are doing, then that is risk, right? So try the best that you can at that. Do the best research that you can. Focus on the fundamentals. Keep a long-term perspective, and take advantage of that volatility.
So we'll wrap it up with one question, which, in a sense, I would like to understand as a student of finance. You've seen many cycles, and I'm sure over the years you've invested, your thought process has only evolved. So if Chirag has to make a checklist manifesto when he's investing in a company, when he's identifying the art and the science of investing, what is that checklist like when you are taking a call on what to buy and, more importantly, what not to buy?
I think everybody knows the answer to this. This is not a revelation, right? We know we want to buy good quality companies at reasonable prices, hold for the long term, avoid bad managements, avoid bad businesses, ROEs of 15-16% growth. So I think the answers are well known, right? You ask 10 managers, 10 of 10 will tell you the same answer. The key is discipline, right? Not to get tempted by poor quality companies at throwaway prices because those prices are that attractive. Not to get carried away with fantastic businesses at obscene prices because those prices are obscene. Not to get carried away with businesses when you don't understand them because there is a big lucrative money-making opportunity. So I think this is not about intelligence. This is not about figuring out something that nobody else has figured out. This is about character. This is about discipline, right? And that's not easy. It's much easier said than done. But I think that's the answer. And
like you just, sort of whispered in everyone's ear a couple of years ago, the trick to make money is asset allocation. 80% of the wealth is actually made by asset allocation. So never ever forget that.
Yeah. I mean, you just fill and forget. This is a business actually you don't need to speak to fund managers. You don't need to do any of that, right? You just have
I'll be out of business.
We'll all be out of business and we should be, right? You just have to invest with a very different time horizon, right? When you invest in insurance, you look at a 20-year product.
Yeah.
When you invest in mutual funds, you're a 6-month, 1-year, 2-year product. Why is that? If you look at it from a 20-year standpoint, who's lost money in a 20-year period? Nobody. You always do well. But that requires character and that requires discipline, which is very, very difficult to do. But I think if there was one word which defines successful investing, is duration more than anything else. So it doesn't matter who you invest with, but it's much more about asset allocation because the asset allocation is key because asset classes will certainly have different return profiles. But other than that, it's about duration. Just hold for the long term. You invest at the worst time. Whether you invest at the worst time or you sell at the worst time or what have you, as long as you've invested long enough, you'll do fine.
We think things change, but one thing which has not changed is getting Chirag Setalwad on TV. So rather than him coming there, now we have to come there.
That's not true.
Fantastic to have you, Niti, now. Thank you for joining us.
Thank you, Nikhil. It's my pleasure.
Thank you very much.
Thank you.
So nice to meet you.
Well, that's the coverage.
If you like this video, then like, share and subscribe to ET Now.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.